Hello, my name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today's your weekly update for February 16th, 2024. Well, rates are going back up. I hate to say it with that inflection, but holy cow. You're going to see a pretty heavy upward trend, and I'm going to pull it up on a chart here. But I'm going to show you a 6-month chart. Now, I want you to notice that rates came down like we predicted, November, December, January, and then again in January, February, rates tend to go up. But it started to go up and then it dipped down pretty hard for about 2 days and then it reset, came back up. Now the upward pressure is CPI, Consumer Price Index, was a little bit higher than expected. It's that fear of inflation. But focus on this little down point right here. How do you take advantage of that? Well, that's what I want to talk about today. So today's conversation, how to take advantage of a rate dip. It's actually quite simple. On a refinance, I'm going to go ahead and draw a line on the chart here. Say anytime during this period of time, we start a refinance and we're moving through it. Now, depending on the investor, as long as the file is through underwriting and approved, and sometimes it needs to be clear to close depending on the investor, sometimes approved but not clear to close, it just kind of depends on the investor. But we prefer the ones that are after underwriting approval, and all the way up until closing. As long as the file is approved and it's moving through the rates are up and down, and we've already locked it back here, right? And rates go up a little bit, down a little bit, up a little bit, down a little bit, and then rates drop, we're doing float downs. We're doing float downs for the entire book of business we have on that day. But on a refinance, you better be approved through underwriting. 2 of the investors not clear to close yet, the rest of them all the way up until closing. Rates come back up again, and you've now capitalized on that low rate. Nice circle here on the chart. Now let's talk about a purchase loan. Purchase loan, similar. You're going to go under contract. Now, in a rate environment like where we are right now, on purchase, we are mostly, almost all the time, 99.99999% of the time, going to put the loan with the investor / lender that does allow float downs when rates are going up and down like they are right now. And the main reason is we get you approved through underwriting on the purchase side, similar to the refi side. Rates dip, you can float down. Now with refinance, you have a longer period of time. You can get all the way up to where you're almost clear to close or clear to close, and you can wait for a week or two, see if rates dip. On a purchase, you cannot. So on a purchase, typically we're going to lock it up front. Then, if rates dip at any time after the fact, we're going to go ahead and float down. That's typically going to be a quick phone call on the purchase side. On the refinance side, we typically do it automatically. On the purchase side, sometimes we're going to do it automatically if we cannot get a hold of you. If we can get a hold of you and they dip quite a bit, like let's look at day 1 here. Day 1 came down a lot, day 2 stayed down there, and then day 3 shot back up again. If I can't get a hold of you at the end of day 1 or beginning of day 2, I'm going to go ahead and float down for you. If I can get a hold of you, then we're going to talk about pros and cons. Maybe it'll go down a little bit more, maybe it'll go up. Now, what's nice about this float down thing is I just had a recent loan, several loans, but one in particular I can think about. We put it in and we locked it right before the CPI came out. So we locked it last Monday, or this last Monday. CPI came out on Tuesday, rates go up. What is it? That buyer's protected. Now, we locked several that day, yeah. But I mean, that's just one that is a conversation we had. Look, you can float, we can wait, we can see if it dips, but you're with a lender that floats down or an investor that floats down. So it doesn't matter if we lock now with whatever rates are at now. So that's how you take advantage of it. You have to get documents in quickly. You have to be approved through underwriting. On a refinance, you can kind of wait that period of time. But on a purchase, you have 3.5, 4 weeks or whatever else, and then that's all you get. Now, to get a good deal on VA, we have an investor on VA that is really low. In fact, it's so low, it's not even on our search engine. When I think VA today is high 5s, and when VA is high 5s with everybody, they're mid 5s. But you'll never see it on the search engine because it literally is a one-by-one, price it scenario by scenario type of deal. One of the main criteria of that is I need a 4.5-week contract. So for you as a realtor, if you have a buyer who's Govi, VA or FHA, and you can get 5 weeks on a contract and get us the contracts right away, get your home inspection done right away. The buyer, the borrower gets us the docs right away. We can use this other investor. They're very cheap, but they are slow as molasses. So we want the 5 weeks. We actually can close it in 3 with that investor, but I want 5 for a safety margin, because if we're ever late on a closing, it doesn't matter what it is, borrower's slow on docs, appraisals slow, or maybe our systems are slow, it doesn't matter. It's usually considered to be our fault by the realtors. So the easiest way to lose business with realtors is be late at closing, unless you're communicating with everybody through that process and you know 2 weeks in advance, hey, we might be a little bit late. Sometimes that happens. Rare, but sometimes. Now, so Govi and FHA, VA, to get the good deal, decent credit. You don't even need decent credit. When one of these guys had like a high-5 FICO and he got a pretty good rate, but we had a long time on that contract. For conventional, you're going to want to be over a 760 FICO range to get a much better deal, and the more money you bring in, the better deal you get. So for example, if you bring in 5 to 15% down, you're going to be at, let's just say, 6.7, just to throw a number out there. So if 5 to 15% down is 6.7 on the rate, 20% down is probably going to be 6.8 or maybe even 7. It goes up at 20% down. There's a reason for that. It's a little bit out of the scope of the video, but 5, 10, 15% down, a little lower rate, 20% down, a little higher rate, 25, it goes back down to where you were roughly on the 5 to 15% down mark. But then in order to get a really good deal, if you did 35 or 40 or sometimes 50% down on conventional, that interest rate's really low. Typically on Govi though, we don't see that break on down payment. But on conventional we do. And then also 760 FICO seems to be that break point of, if you're 760 or above, conventional's most likely going to be the better deal. If you're 720, 730, 740, we've been seeing deals where government's better, FHA's better. So, but anyways, Mike Florin, I guess I'll see you guys later. And remember, we're going to expect rates to keep going up until they don't. Have a good weekend, and I'll talk to you later. Bye.